Well, thanks for tuning into this conversation with HCL Technologies. They delivered, well, slight miss versus consensus on the revenue, but better than expected margins, 18.5 versus estimates of 17.5. Solid order bookings as well. As per brokerages, the other highlight was the cash conversion in the first half, the free cash flow to net income of 139%, and higher dividend on the positive side, and the guidance cut being the negative. C Vijayakumar joins in to put the contrasting factors into perspective for us. CVK, great having you. Thanks for taking the time out. Disappointed that the revenue numbers didn't quite live up, or happy with the fact that the deal wins have been absolutely fantastic?
Overall, I think it's been a very good quarter for us, Neeraj. If you look at it from revenue perspective, uh, actually our revenue also needs to be broken down into just the revenue, which is really services, and then there is always some assets which go into some services. So that asset component had reduced by about 25 million. So if you take this, if you kind of combine it, it looks like 0.5% organic growth. But if you really take out the asset, then it's 1.5%. So generally, very good momentum on services side as well. But our own expectation was we should have done a little bit more on services. I think we executed very well. A lot of investments that we've made in the past in freshers and all the talent development efforts, a lot of them got into billing, which really helped us improve our margins. And we obviously operated with a little more tightness to ensure that we can improve our margins, which again has delivered good results. And the bookings, of course, we have taken away share from several providers on this uh, cost optimization led transformation programs or transformation led cost optimization programs. So the 4 billion booking is very reflective of deals. Some of them are really share gains from others. Some of them are new opportunities on which clients are spending. And the good part of this is we only declare net new deals, which are firm signed deals. They're not rate cards, they're not framework agreements. So it potentially starts translating to revenue in 3 to 6 months in a very predictable manner. So that is what this big booking is what has given us hope for that the execution is on track and we will do very well in the second half. So, given the first half itself, the discretionary spend did not pick up as much as we would have liked. So, that is the reason we had to kind of reduce the guidance for the full year.
Hmm. Did the deal? You had mentioned this to me at the end of Q1 that you expect the deal bookings to be strong despite what happened in Q1, which was an aberration. Did
Yeah,
you
yeah.
anticipate it to be this strong, or does this come as a surprise to you as well?
No, no. We were expecting this because
Hmm.
of the nature of pipeline and the conversations that we've been having with our customers. Because 2 billion is the normal run rate. So when you have a very large deal, 4 billion is a logical kind of expectation.
Okay. A brokerage on one of your peers, but the point that they made was that while the TCV is strong, growth is not coming because I would love to have this perspective from you. They say
Yeah.
that, or their belief is that the growth is not coming because while the large TCV driving half of the growth for IT companies, the flow business, which is scope expansion, smaller deals, etc., are driving the other half, wherein there seems to be a problem. Would you concur? Could you give your perspective here?
Yeah, I think when you look at for every company, we need to analyze whatever is the TCV announcements that they make and the revenue growth and how correlated are they. And when you announce include your renewals, when you include some kind of rate card and framework deals into your booking numbers looks high, but they don't necessarily correlate well with the revenue growth momentum. I was just listening to some conversations. That was the point everyone was trying to get more clarity on. But if you announce net new wins, like the way we are announcing,
Hmm.
we see a very strong correlation to our deal win that we declare to the market and the revenue growth. It's an 85% correlated. And if you do the analysis for others, it's not so well correlated. It's because the renewals, it might add to the booking, but it's actually going to not add any revenue, right? Yeah, because mostly renewals will come with some productivity benefits, so it will only go reduce your existing book of business. So I think it's all on the nomenclature and the definition of what are we kind of disclosing as order book. And I wish everyone has a common definition, then things will be easier.
Yeah, but I don't think that will happen. So in which case, CVK, in your case, independent of how, when the flow business picks up, you believe these large deal wins will lead to
Yes.
revenue growth. If the flow business picks up, then adds luster to
Yes.
flow.
Yes. Exactly. Yeah.
And when do you reckon the flow business kind of improves, if from any particular quarter?
We continue to have flow business. It's not that it is zero, but I think
Oh,
it's definitely much lower than what it was in the last year, for example. So yeah, I
oh,
really cannot take even a judgment call on when the flow business will pick up, but it feels like things have bottomed out. But the world is so volatile, so you don't know what happens when.
yeah.
So we have to take that with a pinch of salt.
Can imagine. So, in which case, just to sum up this argument, or rather this conversation, CVK, on this part, your confidence about the growth in the second half, despite the fact that you had to marginally bring off your guidance, stems from the fact that your reportage enables you to ensure that the deal wins translate into revenue in the second half.
Absolutely.
Got
Yes.
it. Okay. Okay, great. Margins are looking solid. Attrition seems to be an issue behind you. Would that be a safe assumption?
Yes, our attrition is today the lowest in the industry. We are very happy, very proud of that. We've managed to contain attrition uh, and meaningfully, and it's the lowest in the industry. And we would want to maintain it, and that's what is the comfortable range for us.
Okay. One factor that the street seems to be noticing uh, for the three IT majors, including you, that have come out with numbers, is the headcount reduction. It's lowest at your end versus the others, but relatively, all three have brought
Mm.
down headcount reduction. Is this signaling or indicative of some things, CVK, or not to read too much into it?
No, I think it's just rationalizing the big increase in headcount that happened in FY21 and FY22 and 23. A lot of us hired a lot of freshers, and when the demand situation was really exuberant, then we hired a lot of people. So we never, I mean, at least in some pockets, we did not measure utilization and all of that in a very rigorous way. So now that market is slightly is soft, so we are really spending time to making sure every one of our engagements run efficiently. If there are excess people, they get moved into new projects. Then the freshers who are getting trained, they need to get billed. So all of that, the emphasis on those aspects have gone up. So we're all leveraging internal talent pool to do the fulfillment at this point.
Okay. CVK, one last two questions. One is this, the cash conversion, the fact that the dividend has been very high as well. Soft aspects, but any comments there?
Yeah. See, we've always mentioned that quality of business is a very important metric for us. We want to grow business in a very capital efficient manner. We want to continue improving our return on invested capital. So that's been a guiding principle in how we do deals and how do we really look at any of the internal initiatives. And we focused a lot in bringing down DSO. DSOs come down by 5 days, which is it's probably one of the lowest that we've ever had, and even from an industry perspective, it's the lowest. So a lot of very strong operational efficiency measures, which have really helped us to deliver very good cash flows. Our cash flow conversion is at a five-year high. So capital efficiency, ROIC metrics are also very important metrics which we keep in mind if you have to deliver a very good value to the shareholders.
Okay. Last question. The street, us commentator, financial commentators are all used to trying to think of what IT companies can do over 18 months. There always used to be visibility, so on and so forth. Would you shy away from trying to think that far out because of what you precisely said? The world is very volatile. So would you shy away from predicting stuff that far out and take it a quarter or a half at a time?
Yeah, I would prefer to do it in smaller kind of time horizons, while not losing sight of the fact that technology adoption and technology intensity is going to continue to increase across all dimensions of industry and in life. So that is always going to be a very positive trigger for the services business to grow. So that, keeping that in mind, you take a long-term view with that in mind. But when you want to forecast and when you want to do planning, you become more pragmatic, and maybe do it for 1 quarter, 2 quarters, and then take it as it comes.
Got it. Well, congrats on the deal bookings and the guidance for the second half, despite being lowered much higher than what the street has for everybody else. So all the best for that. And to you and your team, wishing you a very happy festive season.
Yeah, happy festive season to you as well, Neeraj. Take care.
Thank you. And viewers, thanks for tuning in.